Something significant has happened between Russia and China. It is a quiet but powerful shift. China has said no to a major Russian energy project. Russia wanted to build a new gas pipeline. This pipeline, called Power of Siberia 2, was meant to carry gas through Kazakhstan to China. But Beijing has rejected the proposal. This single decision sends a clear signal. It suggests the no-limits partnership has real limits. For Russia, this rejection comes amid immense economic pressure. To grasp the weight of China's recent decision, we must first understand the recent history of their economic ties. Following the 2022 invasion of Ukraine, Western nations imposed sweeping sanctions on Russia. They cut off its access to financial markets. They reduced purchases of Russian oil and gas. This left Russia isolated. Moscow pivoted sharply toward the east. China became its most crucial partner. Trade surged. Russia became China's top oil supplier. China supplied cars, electronics, and industrial machinery to Russia. This partnership was built on mutual interest: energy exports for Russia, cheap, abundant resources for China. Described as a strategic alliance against Western dominance, Putin and Xi pledged repeatedly to deepen cooperation. The alliance looked like a new center of power. The economic bond held that vision together. At the heart, Gazprom, Russia's state gas giant. For decades, it symbolized Russian economic might. Vast reserves and extensive pipelines served much of Europe, giving the Kremlin political leverage. The revenue funded the government, pensions, infrastructure, and the military. After Europe turned away, Gazprom's model collapsed. Finding customers became a matter of national survival. China seemed the only buyer big enough. Hence, Power of Siberia 2's importance. It was the cornerstone of Moscow's strategy, redirecting gas once sent to Germany and other European countries to China. Officials promoted it as a done deal. Moscow expected China to agree to the plan. That assumption has been proven wrong, with severe consequences for Russia. This is not just a pipeline deal gone wrong. It's a complex relationship tested by war and sanctions. For years, China was a lifeline. Now that lifeline appears to be fraying. The first clear sign of serious trouble emerged from Gazprom's own financial reports. The company, once a titan of the global energy industry, began to bleed money at an alarming rate. In 2023, Gazprom reported a loss of approximately $7 billion, its first annual loss in over 2 decades. By the end of 2024, losses had grown to around $10 billion. These losses were a direct result of losing the European market, Gazprom's most profitable customer. When those sales vanished, Gazprom was left with unsold gas and idle infrastructure. Some analysts now predict losses could total $179 billion over the next decade if conditions persist. This is not just corporate, it is a national crisis. Gazprom is a major contributor to the federal budget. The Moscow Times noted that Gazprom's catastrophic losses mean the Russian budget is running out of money. This is critical because President Putin spends about 40% of the budget on the war in Ukraine. A struggling Gazprom undermines Russia's ability to finance its military, fueling a vicious cycle. Faced with this, Power of Siberia 2 became an act of desperation, the only plan big enough to stabilize finances. The rejection was not just a setback, it was a devastating blow to Russia's recovery strategy. Just as Russia's need for Chinese support peaked, Beijing began to build a financial wall. According to Bloomberg, major state-owned Chinese banks tightened curbs on Russian clients to avoid U.S. secondary sanctions. At least 2 large banks ordered reviews and plan to sever ties with clients on U.S. sanctions lists. They will stop providing financial services to Russia's military sector. Beijing offers diplomatic support, but its banks are distancing from the riskiest Russian activities. The financial retreat is spilling into everyday trade. Since early 2025, Chinese banks have reportedly rejected yuan payments from Russian clients. After losing the dollar and euro rails, Russia shifted to yuan. Now, even that channel is unreliable. Large Chinese banks are scrutinizing or outright refusing Russian transactions. Importers struggle to pay for goods, trade slows, isolation deepens. China will buy discounted oil and gas, but it won't risk access to global finance to help Russia evade sanctions. China is prioritizing its own economic stability and world market access over a "no limits" slogan. For Moscow, this is a harsh and unwelcome lesson. The numbers from Russia's own finance ministry are stark. By July 2025, the deficit reached 4.88 trillion rubles, about $61 billion, already above the plan for the entire year. The budget broke halfway through the year. War-driven spending rose over 20% in the first 7 months of 2025, while total revenues grew just 2.8%. Oil and gas revenues fell 14% year-on-year. Analysts expect the deficit to hit at least 8 trillion rubles by year's end. By end May, liquid national wealth fund assets fell to 2.8 trillion rubles, below the expected deficit for the first time. The strain on the national budget is creating a domino effect that is now toppling Russian businesses. With war absorbing capital and rates high to fight inflation, credit is expensive and scarce. Interfax reports a 26% rise in corporate bankruptcies in the first 3 quarters of 2024, 6,392 firms. A pro-government center warns more failures ahead, as over 20% of manufacturers pay over 2/3 of profits in interest, up from 10% a year earlier. Debt-heavy zombie firms can't invest, expand, or even maintain operations. Any small shock can fell them. Each bankruptcy means lost jobs, unpaid suppliers, and a drag on the wider economy. The government's stability narrative erodes as everyday hardship grows. Troubles in Russia don't exist in a vacuum. They ripple through energy markets and security dynamics. Russia is still a top oil and gas producer. Disrupted flows can move prices. China's rejection affects Asia-bound gas, forcing Russia to shut in production or find other buyers. Expect LNG market volatility as nations compete for long-term supply. Energy importers like Japan and Germany will bake Russian risks into planning. For the US and allies, sanctions appear to constrain Russia, but collapse risks instability in a nuclear state. Policy choices intensify pressure to hasten an end or manage to avoid chaotic collapse. China's caution signals to partners in Central Asia, the Middle East, and Africa. Deep financial integration with Russia carries risk. Further quarantine of Russia's economy would heighten its isolation and test global finance systems. As of October 15, 2025, the facts paint a stark picture for the Kremlin. Key areas: Gazprom's health, the federal budget, private sector bankruptcies, and the message about the Putin-Xi alliance. Understanding this shift matters far beyond Moscow. Tonight we break it down piece by piece, calmly and clearly. Beijing's decision has created global ripples. What exactly did China do? Why now? And what does it mean for Russia's future? One financial analyst put it bluntly: Gazprom's gas business is suffering catastrophic losses. This is not just a shareholder issue, it harms the Russian state itself. The budget is running out of money. About 40% goes to the war. Failure at the energy giant undermines funding for the very conflict driving the crisis. Choices: cut spending, including military, or borrow print and risk inflation and a weaker ruble. Another expert calls Beijing's moves a masterclass in strategic self-interest. Buy discounted Russian energy, but shield banks from US sanctions. A dual-track policy maintains supportive rhetoric while enforcing strict financial compliance behind the scenes. China is deeply integrated with global finance. Managers will follow US Treasury rules over personal promises. The lesson: in international relations, national interests outweigh personal assurances between leaders. We have seen the evidence. Gazprom is posting historic losses. China has rejected the pipeline plan. Chinese banks are stepping back, even from yuan payments. The budget is spiraling, savings are being drained. A wave of bankruptcies threatens jobs and stability. The road ahead is perilous. The world will be watching.